Thanks everybody. So I see you can't see everything here, but I'm pretty sure I can change that. Yeah, welcome to the, I think, last tutorial in this track this afternoon. Pretty happy to see so many of you here interested in interactive analytics. Actually, this is a tutorial that I gave in similar fashion at the PyData in London a couple of weeks ago. And I prepared for like 2.5 hours with a little pause planned in between. So it was like of the most skilled crowd I ever had. We went through this stuff like pretty quickly. I have 3 exercises and all the people, I wasn't really used to that. They solved it so quickly. I was pretty amazed. Then I thought 2.5 hours was, well, obviously too much time. So we squeezed the whole thing into 1 hour. So I think and hope it will fit. I added also a simple example. Oh. This was the button that was pushed by the plug. I've also prepared another simple example because I was asked how to interface with real-time APIs over the web, and I will show this later on when we have passed our first example. For those of you interested in the stuff, just go to my website, www.hilpisch.com. There you find a single page with the link to all the things, and here are the links provided again. But the easiest thing is just to navigate to my homepage. You find links to everything, even the IPython notebook underlying this tutorial. Couple of words about me. Maybe not everybody in here was in my talk present this morning. I'm Managing Director Europe of Continuum Analytics. I founded Visixion almost 10 years ago, which we call the Python Quants. I'm a lecturer for math finance in Germany at Saarland University. My focus is obviously in the finance industry. I call myself the Python Quant. My book, Derivatives Analytics with Python, you can have a look at it outside. We will raffle off a couple of copies. I think I brought like 10 copies with me. You can also navigate to the website and buy there, for example, a PDF version of it. The other book that I'm writing currently has been released as an early release a week ago. If you're interested, don't miss to pick up a discount code at the O'Reilly table. Then you get a 50% discount on the ebook and a 40% discount afterwards on the print version when it's out. Yeah, I'm a PhD in math finance and also martial arts fan, and looking forward, as I said this morning, to UFC 171.
Is that the latest one, Python for Finance?
The Python for Finance is the new one, actually. Yeah, the other one came out last year. Derivatives Analytics and Python for Finance is a new one with O'Reilly. So. Only online. The first 4 chapters are released. 125 pages. And we will add content on a monthly basis, minimum. So I have much more already, but they haven't reviewed it. So I'm faster than O'Reilly in this case. Well, here it is, the book. You see it's already designed, and on the page you will see the raw and unedited mark on it. Python for Analytics. This talk focuses on Python as a general purpose financial analytics environment. I have only interactive, as the title suggests, analytics examples with me. And it's more prototyping than kind of being concerned about production, development, maintaining, documentation. That's kind of what a data scientist or financial analyst, a research guy would more like do. So let's dive into this. A fundamental Python stack, or you could say finance stack, is mainly comprised of the following libraries. Of course, you need Python, the interpreter, or any other version. NumPy is, of course, a workhorse when it comes to array structures. SciPy, beautiful collection of scientific models and functions for regression, optimization, integration, stuff like that. Pandas, of course, right now pretty popular in the finance sphere and any other field where data is crunched by using Python. PyTables, the really valuable tool to store data efficiently. With PyTables, it's pretty easy to get to hardware-bound I/O. I used to stress as one of the advantages of Python that you can get to the maximum of what your hardware provides pretty easily. Of course, there are usually many other approaches you could take, many other languages, many other technologies, but Python generally makes it pretty easy, and PyTables is one example where you can get to the absolute hardware speed limit with ease. This is built in from the ground up. You don't have to worry if the 512 megabytes are to be optimized. No, this is usually hardware bound when you have a SSD hard drive in your machine or on your servers. Matplotlib, of course, and what you see here in my slides, completely done in IPython. I mean, this is what you need to follow all the things when you download the IPython notebook from our website. The first financial analytics example. What we need to do, of course, when we use Python is usually to import a couple of libraries. Of course, we need NumPy, as I said before, one of the workhorses. We need pandas, and what I also use here is a convenience function from the pandas.io data sublibrary, and I also use URL retrieve from the URL lib. To what we're going to do here is just like when you see code where it's try and accept is, for example, when I flew over here, I do lots of these stuff on the airplane where I don't have internet access, so I usually have kind of data sets on my machine where whenever I can't do the interactive stuff with the web, I try to have these data sets that I need with me. What we do here is kind of retrieve data for the German DAX index. I'm German, so I usually use the DAX as my favorite index to show off these examples. And you see here we import data from 2007, end of March, end of the first quarter until, well, yesterday here when I prepared, or the last time I updated the slides. This is our data that we want to work with. You see here the last couple of data points, the last 5 rows from mainly this week and 1 day of the last week. And we have now our data set where we can start implementing our analytics functions. But in the end, what you should notice, I mean, you're probably accustomed to that, and you know that the pandas strength lies in the handling of these data. So whenever you see tables, labeled data, structured data, index data, this is where pandas comes into play and makes things generally much more efficient than using something else. For example, what we're doing here is to implement a vectorized operation on the whole data frame. A data frame is kind of a very intelligent, so to say, object or class. Here our object index contains a number of things. Among others, we have the closed data, and we use this closed data to calculate the log returns over the whole time series. And you see it's kind of a single line of code. I don't have to loop or anything else. I just shift the time series by 1 day, and this is what I use as the divisor in this case. And I get, by a single line of code, I get my log returns as a new column here. I define here the new column, so to say, on the fly. See it here, I give it a name, and I define a new column, and my data frame is enlarged by the log returns of my time series data. What I can do, of course, again, pandas is about convenience. I can plot the stuff that I have in there. I can plot the closing data that I've used to calculate the log returns on the one hand, and of course I'm interested in the returns. And you see here a couple of noticeable things from a finance point of view. You see, of course, that volatility obviously is not constant over time. You see these volatility clustering effects where you have these periods of high volatility, then markets coming down in terms of volatility, and usually this is negatively correlated with the performance of the index. So what is called usually in finance slang the leverage effect, meaning that when markets come down, people are getting nervous and volatility rises because volumes rise, and market returns are highly oscillating in a sense. When everything is going up, like in the period we are right now, you see kind of almost a straight line. Pretty good returns over the last couple of months and years. So you see markets coming down and volatility getting a little bit lower. But still, you get all these things like, right now we have 3 lines of code and we are already arrived at the graphics of our data. What we also want to have a look at maybe is, if you analyze such data, is the rolling volatility or analyze volatility on a rolling basis. This is also pretty easily done with IPython and pandas. Here, of course, IPython our environment. You don't need to use an IPython notebook. You can access these functionalities, of course, differently from the shell or from whatever, from a script that you execute. But here you see you have the function rolling standard deviation. I put the window to 252 days for a training year, and I have to scale it by the square root of the number of days that I'm using here to arrive at the annualized rolling volatility. And I can plot this as well. And once again, if you're interested whether the Black-Scholes model with the constant volatility is a real market representation, you can refuse it by only looking at this chart. There is no constant volatility. Volatility changes obviously over time, and this third subplot supports the hypothesis that I formulated before. When markets coming down, volatility tends to increase, and the other way around. So volatility and performance are usually quite heavily negatively correlated. We'll come to that later on. How many of you have their notebooks and want to do an exercise? Oh, there are a couple. For those who have in a notebook, maybe you can discuss possible solution strategies. The others might want to type it. If you have imported everything I've imported, you should be well equipped. What I want to implement with you right now is kind of a simple exercise in terms of implementing a trend-based investment strategy based on the VSTOXX 50 index, another index. I use the DAX index. But you can use any time series there. You can also use a single stock or whatever interests you. We want to use two trends, a 2-month trend, 40-day moving average, and a 1-year trend. Allowed our long positions in the market, where we use the VSTOXX 50 as a proxy for the market, short positions, and cash positions. What we assume is, this is written down there, when we are in cash, there is no interest on it. It's just parking money, and I mean, it's pretty close to the current situation. When you have cash, there's no interest to be earned right now on that. What we also assume is kind of that we are operating in a perfect market. There are no frictions, that we can buy and sell in any kind of fraction, and there are no transaction costs. So when we go long, or we go long, this is kind of the signal generation, when the 42-day trend line, the 2-month average, crosses or is 100 points above the 1-year trend. We go short when this shorter trend is 20 points, or actually this is a mistake, I use a symmetric thing, it's 100 points below the 1-year trend, but you can use whatever points you think are appropriate. And we invest in cash when the short-term trend is in between these bounds. So we have 3 things. Short-term trend is high enough above the long-term trend, then we go long. The other way around, when it's low enough below the long-term trend, then we go short. And when it's within the band, we park the money in cash, but earning no interest, no risk, no fun, so to say. Any ideas? We might discuss what we can do. How can we implement that? Once we have the data imported, this is what we assume, either using DAX or whatever. Yeah.
Define what you mean by trend.
It's a moving average.
Take the difference of the 2 moving averages, and then for all the indices which is in that round, make it equal to 0. For others, I don't know, the position is plus or minus, or is it scale that's
The position is?
when I am above 1 pound, what is the position? Is it just plus 1? Like
Yeah, that's a question. You can do that. This is actually my solution to that. Yeah.
Yeah, we just equate it to plus 1 minus 1. And that's it.
Yeah, that's true. That's a good strategy, at least a simple one, to do it mathematically, arithmetically here. That's what I would suggest, to use a +1 to say we are invested in the market, and +1.
Can we zoom in a little bit on the slides?
Actually, I don't know.
Control plus?
Yeah, but it doesn't scale, actually. This is the CSS doesn't allow it. It is the reveal.js IPython thing. You see, the handles get larger, but only thing yeah, we were at the strategy how we generate a signal, and I was saying, or confirming, that this would be the strategy I would follow, like to say +1, I'm in the market, -1, I'm shorting the market, 0, I'm earning nothing, I'm not in the market, neither long nor short. So this is the strategy, and then we have a very efficient mechanism to multiply our position with what? This is the next ingredient we need. We need to judge performance. I mean, where does performance come from?
The returns.
Yeah, the returns. Position multiplied by the returns. When I'm -1, I get negative returns of the market. When I'm +1, I get the returns of the market. 0, I get nothing. So let's start just to import another data set. Here the ticker symbol for Yahoo of the VSTOXX 50. Once again, you can use whatever you want to do. The rolling means, the trends are defined pretty easily. We have already seen the rolling standard deviation function. This is the same procedure. We just define the window. Here there is no scaling in a sense. We only have the mean to calculate for 42 days and 252 days. You can have a look at this. This is kind of a typical chart that in recent times at least you have seen in a couple of financial papers in the press. And you see the basic idea of the whole thing. Whenever as the signal says, whenever the short-term trend is above or sufficiently above the long-term trend, then you should be invested, and the other way around. So this is kind of this crossing thing where you can decide whether to invest or to disinvest or to park in cash. But we want to make it a little bit more formal, and this is what we do here, actually, where we decide, well, are we high enough above the long-term trend with the short-term trend? This is the first thing that we do here. It's kind of the where function from NumPy. As you can see, we can also call the universal functions from NumPy provided universal functions to pandas. This is pretty convenient, actually. You see here, whenever the difference of the two trends is high enough, I put a 1, I'm long. For all the other situations, I put a 0. And the second thing says whenever the difference is negative enough, in a sense, I put a -1 and I keep all the other values. So I have a two-step procedure. I could also mingle that together in one thing, but I think compactness is not the only criteria that it should apply to the code. So I divide it here in a two-steps procedure to make it a little bit more readable, actually. So we can visualize that, and here you see the basic idea in the beginning. Because we don't have a trend for the time series, I mean the 252 average can start only after 252 data points. We have nothing, but we start with shorting the market. Then we have a pretty short period where we are cash only, then we go long the market, and I mean you get the idea, the basic idea here. And this is actually what we use to multiply this with the market returns, but we don't have the market returns yet, but we have seen how this works before. We can calculate the log returns of the market pretty easily by just shifting our time series by 1 day and taking the log of the 2 time series that we have. And what I call here the strategy column, this is where I put the market returns in. So I take the returns, multiply these by my signal, which means when I was long yesterday, I get the returns of today, so to say. When my market was 100 yesterday, I invested yesterday, and the market goes up to 105, then I have my position from yesterday and have my return from today, so to say. Therefore, I shift the signal as well. Do you think this is a good strategy to follow? Not good? No? Shaking heads?
I don't like it.
I'm not asking about liking, I'm more asking about like financial things. The performance, what you have afterwards on your account. Well, in this case, considering that there are no transaction costs and everything involved, the strategy turns out to be much, much better than market. But I mean, it's a long-term thing. I discussed this, I don't know if you attended the talk of Brian Wisk. When you're on the hedge fund side and you're not doing anything for like a year, I mean, this is not like, this is not what you get paid for. But if you would devise or would have to devise kind of a strategy for your own pensions and you want to invest your money, you should consider this because it's a pretty simple approach and it usually outperforms. But for a hedge fund manager or for a fund manager at all, it's kind of, when you're doing nothing and sitting on cash, they don't want to pay you any kind of fee for that. So this is one of the reasons why these strategies are not that popular on a long-term basis. I mean, you could, of course, like change the scale to like 1 month and a 2 month or whatever, then you get more trading signals, you generate more transaction costs, and you show that you're doing something. But I think this is something you should consider when you do it on your own, and you can backtest it and optimize and tweak it. But still here, the market has had a negative performance. This is pretty clear from our chart here. You see we started at a level of 4,000 something, and we ended up at a level of 3,000 something, so we had negative performance. But this strategy, due to the fact that we are allowed to go short, we're making huge returns in the beginning here, and you're doing much better. You end up with a positive return over this period of time in particular. This is no financial advice, by the way. It's just illustrating Python with some stupid things. I was talking about correlation before. I want to turn your attention now to a very interesting topic from my point of view. I've been working with Deutsche Börse and Eurex in particular for quite a while. We did a project for them which is called Advanced VSTOXX Services. You should look it up. We did a lot of things there. I provide later on the links to that, where we have kind of implemented all the necessary theory, so to say, for example, how to calculate a volatility index like the VSTOXX by using real options data, using the formulas, and we have implemented complete Python scripts like where you can replicate real time the volatility index, which is kind of an arcane beast, so to say. But you find everything not only explained in theory, but also via executable Python scripts to apply that, also to value volatility options, to value futures, and to calibration of the volatility option pricing models and stuff like that. So it's kind of a pretty neat thing, which you should look up if you're interested in volatility trading at all. But let us start with the VSTOXX 50 and the VSTOXX, where the kind of a stylized fact is that the VSTOXX index and the underlying, or the volatility index like the VIX and the underlying index like the S&P, or in this case the VSTOXX and the VSTOXX 50, are highly negatively correlated, which makes the VSTOXX index and options and futures on that kind of a very good hedge product. So you want to look for support of the hypothesis that this is indeed true. What we do here is kind of, once again, download data. You won't find the whole data on Yahoo, for example, so we download it from the original source, from STOXX, the index provider. There you get on a daily basis, immediately after trading is finished, you get updated versions. So the names are not that kind of good names, I feel. But still, these files are updated on a daily basis, and you always get the current data from these links here. Once you download these and have a look at these, you will notice that the VSTOXX file is not in such a good shape that you can import it directly. So what I want to do here is kind of, I mean, it's always when you're working with real world data, it's not kind of that cleaned up, and you can import it directly and you can work on it. So we have to do a little bit of house cleaning here. There's especially one problem, which I want to highlight here. When you go to line 3883 of this file, you will see that after a couple of lines, at the end of 2001, they just added a semicolon at the end of each row, which makes it hard or even impossible for pandas import that, because pandas thinks that there is another column, but there is none. They just put another semicolon at the end of the row. So I don't know if you see it when I go to the point. Here is for the first time that you see the semicolon. Here is none, up to then, and here is. I don't know why they did it. I don't know why they didn't change it. You know, it's kind of, this is just a file where they add one line after the other, day by day. So we have to do the house cleaning. If they would do it once, nobody else in the world should have to do it afterward. But I haven't approached them. I use it as an example quite regularly. We import the whole thing. What we do is kind of make a nice header line and rewrite just the red thing. The header line is amended by another column name that Panda thinks, oh, well, there's another column. So we don't get into trouble once the semicolon appears at the end. So from the outset, Pandas thinks when importing that there is this additional column that isn't there. And when we open it, it looks a little bit different, especially the header is like cleaned up. And this is in a format right now that we can import directly with Pandas with the read CSV function. We say the index column is 0, should pass dates, the separator character is a semicolon, and the day first convention is used here. Because European data, we put the days first. And after importing, what I just do is drop the artificial, the helper column. I don't need it. So now I have a clean data set. I have a Pandas data frame with all the data in there. Fortunately, the VSTOXX data is completely clean in the sense that we can import it directly. So there is no data cleaning necessary, actually. But on the other hand, we don't need all the data that we got. First of all, the VSTOXX data is not that long available as the VSTOXX data, because the VSTOXX is kind of invented and started be quoted pretty much a good time later. So we have data for the VSTOXX, I think, from 87 on, but for the VSTOXX only from 2000 on. So we get rid of all the data before the first trading date of the VSTOXX. And what we only are interested in is kind of the main index values. So we just take out one column per data frame that we have right now. So in the end, we have our data frame. When I call the info method on that, this was changed in the most recent version of Pandas. I get the information here. Now I have my data from 2000 beginning up until, this is the 18th of February. I thought it would be a little bit Well, I updated it, but it doesn't make any difference, I think, in terms of results. The results remain the same. So we have kind of a nice data frame that we can work with because we are only interested in the main EuroStoxx index and the VSTOXX index. When we have a look at the beginning, you see here's kind of a pretty much different scaling. Of course, I mean, the EuroStoxx is a stock index. We saw this before, 3,000, 5,000, something like that. The VSTOXX is a mean reverting index in the sense that the VSTOXX stands for kind of implied volatility. A weighted average of implied volatility. This is supposed to be mean reverting and on a completely different level. It usually fluctuates around 15, 20 points in a sense.
Volatility for the EuroStoxx?
Yeah, yeah.
And is it kind of analogous in its construction to the VIX?
It's pretty much the same, yeah. The whole theory, like model-free replication of variance and everything applies, so they derive from the same theory to derive the index. Maybe there are minor differences, but the basic formula even looks the same. So there's no kind of, no different innovation behind that, so to say.
I mean, I think the VIX uses all the strikes 1 month out or something and averages them together.
Yeah, they make like a fictitious 30-day maturity. This is hold constant by a mixture of 2 maturities if it's necessary. And they use a couple of the out-of-the-money put and call options to get like the premium and the only the option premium on the out-of-the-money options to synthesize this value. Yeah, you should look it up on the website. We have like written the whole Python-based tutorial on that. So here you see already when we inspect the two time series, further support of the hypothesis that they are negatively correlated. You see, whenever the original stock index is coming down, the volatility spikes. You see it best during the crisis 2007, 8, 9, where we had the highest volatility values also for the VIX. I mean, the same picture would apply mainly to the VIX index, where you see the high spikes around the 80s, 80 plus levels here, implied volatility of 80%. And you can also pretty well see that markets have come down and calmed down to a low volatility level right now, well below 20%. So volumes have come down, markets have risen, and volatility has come down as well. We want to do it a little bit more formal to this end. We use again the log returns. We want to work with the returns in kind of a normalized fashion. And what we do here is using ordinarily squares regression function that is built into pandas, where we provide the dependent variable, here in this case as the VSTOXX, and the independent variable as the EuroStoxx data. And here you see the output is kind of a number of information that you see here. And as we all know, a picture, there's more than 1,000 words. Here you see the results plotted. The red dots are actually the scatter plot of the EuroStoxx returns against the VSTOXX returns, and you see the linear regression line, which pretty well illustrates the negative correlation. This is the data that we've seen before. The negative, the better, if I find it right now. Here you see the intercept is almost 0, and they have the coefficient, the slope of the line by minus 2.7. A strong negative correlation is built in here, and we see the blue line illustrating this graphically. But you might ask the question, did this change over time? So you have a couple of options to plot this data differently, and I have brought one option with me which illustrates or which puts a third dimension into the same or mainly the same graphic. We see once again the EuroStoxx returns plotted against the VSTOXX returns, but we also see by the different colors from which date the single data points are. So what you should notice here when you have a look at the screen is that mainly what is kind of obvious here is that all the yellow points, all the outliers on the far right and on the far left upper side are from the financial crisis, where you see like this whole like really negative thing. When you think of a regression line you would put into there. With Bayesian regression you could actually pretty well visualize this also like the time dependent regression over that. And you see like in most recent time you see all the red dots in the middle of that. You see that we are in one of the most calmest or slowest or whatever you want to call it market environments right now, where you see that this almost nothing happening. We don't have any outliers which are dark red, which stands for the most recent stuff. So you have an option here to like put a third dimension by using color. Of course, when you have a printed book, I don't know, I have this example in my current book as well. You will only see and notice it on the in the online version. Actually, I don't know how it looks in a black and white printed version, but maybe you get the idea here. What is behind that? So we have a changing market environment to see, like by using these colors, how this is breathing in a sense. All the outliers once again during the crisis, and right now we are in a very calm and slow period actually. I have another exercise. Just to check whether our returns are normally distributed or not. Those of you who want to do it, I mean, this is nothing to really discuss. This is more like to get your own experience when you want to have a look at. To answer the question whether both of the time series, VSTOXX 50 and the VSTOXX returns, are normally distributed or not. I mean, large parts of financial theory is based on normal distribution, like portfolio optimization that we have heard from Professor Jared Lander this morning, or was it lunchtime? I mean, this is all based, like also the Black-Scholes one is all based on a normal assumption, CAP-M, portfolio optimization. So many examples in finance theory, but as we might know, typically they aren't normally distributed, and there are a couple of nice approaches to test this and to maybe inspect this and have like by eyeballing to have a feel for that. So we have two ways actually. We can use graphical illustration, the QQ plot, the quantiles, the theoretical quantiles plotted against the actual quantiles, and we can use, of course, statistical tests. You find the one thing in the stats models library, and the other one, if you want to, I mean, you find alternatives. But I use the stats sub-library of SciPy to do a normal test, which is kind of what I use is kind of a combination of the of kurtosis and the skewness test for the thing. First, what we want to do is kind of doing a QQ plot. Here you see this is kind of a benchmark. I generate, in this case, 1,000 pseudo standard normally distributed random numbers, or standard normally distributed pseudo random numbers. I think this is the right way to express it. And if you have standard normally distributed random numbers, this should be a straight line when you plot the quantiles against the theoretical quantiles against the sample quantiles, which means that you can put a straight line into your observation points. I mean, in details, we have a little bit like a tail effect here, but mainly you would agree that this is a straight line and that the line pretty well approximates what we see in practice here when it comes to our values. Just to have this as a benchmark visual thing, so to say. Now have a look how the VSTOXX returns look. This looks pretty different, I think. We see the theoretical quantiles again on the x-axis and the sample quantiles on the y-axis here, and you see what is typically called fat tails. We have both positive returns and negative returns, which are well off what would be expected when the returns would be standard normally distributed. So you see these deviations from the linear line, which is a pretty good instrument to get a feel of how your returns are distributed. Mainly the same thing applies to the VSTOXX returns. I mean, this is a completely different kind of beast, but nevertheless you can plot it in this way, and you see that here as well we have the heavy tails, but this is kind of, when you think back of the picture that we have had here, you see all the outliers that are coming together. It's kind of this long thing. Of course, when I have outliers for the one thing, the thing in the upper left panel, so to say, imply that we have outliers for the others as well. So this is what we see here in the QQ plots reflected. Both of these show large tails or larger tails than would be expected or would be kind of in a confidence interval for a normally distributed return series. Now I come to a very interesting point. This is one point Eurex asked us to stress on the website as well. So to this end here you find now the links to the applications. We not only implemented and wrote a tutorial based on Python, providing the theory and the executable Python script. What we also did is kind of, we wrote two backtesting applications, a simple one and a more sophisticated one. In a sense, the one is only for two assets, backtesting. Okay, maybe, yes, I have internet access. I can go to it. but it's not too fast, obviously. Maybe it takes a while until it loads. And what the whole thing is about kind of is to show that whenever you put VSTOXX or VSTOXX instruments into your portfolio, you should expect, when you're an equity investor, a European-based equity investor, you should expect an increase in returns, because these two things are supposed to be negatively correlated, which means that whenever the market goes down, this should provide a hedge for you as an equity investor. Now it has loaded, I think. You see. This is one of the applications. What I can do here, this is the simple one. Here you are just allowed, so to say, to mix a straightforward investment, which is actually not possible, what we assume this year, a straightforward investment into the index with a position in a straightforward investment in the VSTOXX. So this is also not possible. But you can think of like exchange traded funds or something that...
Do you have an ETF fund?
Sorry?
Is there an ETF?
No, actually no. There are futures and there are options. And the other backtesting application allows you to devise strategies based on options and futures.
So
With rollover strategies and...
hedging will not be as simple as...
No, usually that's kind of involved. I mean, options have kind of maturity and the futures have to be rolled over. So,
There's the margin.
yeah, of course. You can also add transaction costs and stuff like that to the other thing. And you can...
Hedging is not that simple.
Yeah, but just to illustrate the point, what is meant by that, what we want to replicate in Python is here you can have, maybe go to another date or a more current date. What you see here is I can kind of mix of the portfolio. This is in relative terms. You see it here when I just go to a level of 30%, for example. You see the blue line, the portfolio line. And you see the other lines. The green line is for the VSTOXX index, and the red line is the EuroSTOXX index, which didn't perform too well over this period. But you see, once you mix this in a constant proportion manner, which means that whenever like there is market movement, then the whole portfolio is rebalanced to have a constant proportion invested in the VSTOXX. And if you follow that, and like in this case, assuming away all the things like transaction costs and frictions, and that you're only using futures, and you know have to roll over your future strategy and stuff like that. So, but apart from that, just to make the point, you see here you can get huge performances by mixing this up, by having this constant portfolio strategy implemented. You see here the data. You go to that, the EuroSTOXX performed with minus 23%, the VSTOXX performed mildly positive, but combining these gets you a huge performance. This comes out of the negative correlation, which means whenever the one thing is losing money, the other one will bring you money, and in this case the VSTOXX is overcompensating for all the bad things that happen to that. You can also see the Sharpe ratio in here, and this is kind of good strategy, but I don't want to like show this thing off. You can do it by yourself and play around and go to the more complex one. I want to replicate this exact thing in Python, which is actually not too complex. The strategy we want to implement, you can think of 100,000 euro, but this is just kind of a benchmark value, 100. We normalize that. And what we want to do, for example, is 70% to invest in a diversified equity portfolio, which in this case is our EuroSTOXX 50 direct investment. And the remainder, 30% I invested in the VSTOXX index directly. This is kind of the same thing. We assume away all the market microstructure elements that nobody is really interested in, at least when they're doing research. So everything is infinitely divisible, and all the typical assumptions that you have in your theoretical models. We use the same data that we had before. We have everything we need in there. What we do is kind of drop all the NA values, because what we want to calculate doesn't work when we have kind of not the number values in there. And we normalize the whole data series to 100. This is what is done here. And in the end, you have kind of the first 5 data rows presented here as the head of the data frame. So it starts at 100, and you see it goes to, of course, goes lower, the other thing goes up. But here you see already in the first 5 days how this works in principle, that on the second day that we see here the EuroSTOXX is going down and the VSTOXX is going up. This is actually what we're talking about here and the effect we want to use. So now comes the investment strategy, where we say, well, we invest 100 or 100,000 or whatever amount you like, and our constant ratio is 30%. We invest 30% into the VSTOXX, and the remainder we invest in the EuroSTOXX. So we have 2 new columns in here. We have the investments on the one side in the equity, and the other thing is thanks the volatility part. You could say, well, this is already a strategy, so I start out with like 70 and 30%, and I don't do anything. It's a passive strategy. And as it turned out, I mean, this is a strategy, but this is not kind of pretty good. So you see here the VSTOXX against the static strategy. And if you would have exited the strategy around the end of 2008, around the beginning of 2009, you would have made a little bit of a return, but otherwise it doesn't perform too good. So this constant passive investment strategy doesn't work pretty well. So therefore we want to have this constant proportion investment, where we say, well, we keep the investment in the VSTOXX index constant at 30%. And this literally at 30%, so we do it mathematically correct. With our more sophisticated backtesting application, you can say, well, I have a bound around 30%. For example, I only rebalance when it's like 2 percentage points above or below, so that I have fewer rebalancing activity, therefore also fewer transaction costs that I incur. So here in this case, what I do is kind of write a looping function, and I go step by step and do the rebalancing. I don't want to go into the details. I mean, you find all the stuff on the website. You can go into the detail, or you can download it, or you can use it by yourself. Put in the current data that you downloaded from the Eurex site and confirm it for yourself. But mainly what it does here is kind of, we have the value of the equity position, then we have the value of the volatility position. We have, of course, a total value, and whatever we do after a trading day ends, we rebalance the portfolio to keep the investment in the VSTOXX constant. So this is what this function actually does here. And when we have a look at the data frame that we have here, which then includes also the dynamic column, which is the performance of the strategy, we see that we have for the VSTOXX data, the VSTOXX data, we have the 70% in the equity, we have the volatility position, the static strategy that we have devised before, and we now have the dynamic strategy. And just to confirm that, I don't have the value of the positions. Here you see I have only the ratio stored, the 70% and the 30%, and the equity and the volatility column. But just to check whether we have a constant proportion investment, I just multiply the position by the value of the security relative to the value of the whole strategy, of the total wealth, and you see, fortunately, this is indeed constant over time. You have a constant proportion investment here of 30 to 70%. How does it look? This is an amazing performance. I mean, when you look at this, you see over time, we've seen this before, markets have come down. There's a negative performance in the VSTOXX, but this dynamic strategy outperforms the market pretty well. So we have a performance of roughly 300%, so quadrupling of our investment, while the underlying index has performed bad, so to say. I mean, every negative return is bad. Sorry.
What is dynamic exactly? I mean, you said you're going to keep it to 30% for the volatility, right?
Yeah.
And then you're going to change the percentage for the equity? That's what you said?
No, I mean the percentage investment in euro or US dollar terms remains constant. So you either have 30 euro to 70 euro, or you have 300 euro to 700 euro. You always have 30% invested of your total wealth. I mean, the total wealth can come down, of course.
Yeah,
you can go from 100 to 90.
Dynamic here? What is changing?
Dynamic is that I have to rebalance the number of securities that I have in my portfolio. So I have to buy and sell both securities with every time. Yeah, I mean, when I talk about securities, I mean these fictitious securities that are not available. I mean the both of the indices.
So it's index and index.
Index and index.
But the index of the volatility is always 30%.
Yeah.
Right? So only the percentage of the whatever the equity index is changing, percentage-wise.
No, percentage-wise.
I mean, relatively.
Neither one changes. I mean, this is the whole idea of the strategy. I keep the proportions constant. No matter which total wealth you have, 100, 500, 50, 250, I say I always invest 30% of my total wealth. Yeah. Therefore, I mean, once you have invested 30% in the VSTOXX and 70% in the VSTOXX, and then you are looking at your positions 1 day later, then markets have moved. Then you will see, well, I had 30%, but now it's at 28%, and 72% is in the equity portfolio. I don't want to have that. So you're selling the one position and buying the other position, such that you remain constant.
Rebalancing, theoretically speaking, every day.
Every day, yeah. And this is what I said, with the more complex application, we allow for like a band, that you say, well, I won't rebalance until...
You're rebalancing so frequently, what about the transaction costs?
This is, I have defined them away, in this case.
Okay.
Once again, the more complex thing allows to change transaction costs.
So when you did not rebalance and the performance wasn't good, what were the final weights of the VSTOXX and the EuroStocks? I mean, how did it drift? Was it that the stocks went down and so you ended up owning too much volatility, or was it the other way around?
That's a good point. I mean, the whole thing went down. I mean, if you have a look at both time series, they don't make any return over time. In this particular example, where do I have these?
But presumably,
Here you see that both of the time series, both have come down over the period.
Yeah.
I mean, you're losing money on both positions.
Well,
So total wealth is shrinking systematically, so to say.
well, yeah, but it must, you know, the relative weights must have changed.
Yeah, they have changed, but I could look it up in the DataFrame. Actually, we can do it maybe after the talk. I don't have the number, so I myself wasn't too interested. I only saw that it doesn't work out, and that it doesn't work out we have seen in the static strategy. In between, this is kind of the green one is the static strategy. You have this huge spike over the crisis,
Yeah.
but then it comes down again. Because in the end, over the whole range, no index is doing a positive return. So I mean, where should the positive return come from? You can only get negative.
So basically, if you look at this, static is doing fine in times of, you know,
High stress.
exactly,
Yeah.
2003 and 2009, and then otherwise it just, you know, not really.
Yeah. Let's do it. And the dynamic one, we've seen this is doing pretty well because you're always adjusting and you have this, let's say, overemphasized effect of the negative correlation. Here, so to say, this is the best way to capitalize on the negative correlation. Not the static one, but to rebalance it, to like being overexposed and underexposed. The one way or the other. It's kind of having a wind for a sailboat, you know, it's kind of going with the wind, where the markets are.
It's probably just making money because you buy the vol index when it's low and sell it when it's high. Like I bet you if you didn't have EuroStocks in there at all, you get the same profile. You know what I mean? Like it's just saying vol is mean reverting, buy it low and sell it high by doing your rebalancing.
Yeah, but I mean, I'm doing the optimization. I can show you that this is not actually true because my next exercise, we don't have the time to implement it, but what I have here is kind of, actually, I'm posing the question, what is the optimal weight for that? Actually, once again, with our more sophisticated backtesting application, we have two buttons. The one is optimize return, or the other one is like minimize risk, like in a portfolio management sense. But here, the only thing I want to do is kind of finding the optimal weights to get the highest return, or the weights that get me to the highest returns. So what you have to do is kind of just implement this as a function and optimize over that. I don't do any optimization, I just loop over different values. What you see here is kind of, when you start off with a VSTOXX index of 0%, this is kind of the straight equity investor. This straight equity investor is losing money over time. The passive investor invested in EuroStocks is losing money, minus 35%. And this is spiking, peaking here at a 50-50 by incident. This is not kind of a systematic thing. In this case, it's a 50-50 allocation, which gets you to a 406% thing. And we see here the 30% that I used before, these are the roughly 300% plus that I said before. And once you get to the complete VSTOXX thing, of course you're losing money as well, because as I said, over the whole period of time, both indices are losing money. You're only making money by having this constant proportion investment and using the highly negative correlation.
Or because you're allocating into EuroStocks when vol is high and back into vol when vol is low. Right?
Yeah, because I mean, but
It could be cash. What I mean is cash instead of EuroStocks.
of course, other things will work as well. I mean, with cash, you could even be better off, but you don't have a kind of. You could add short strategies. We once again, I want to point and redirect you to our more sophisticated backtesting application that you can do sophisticated stuff, or even you can have 4 assets in there. It's also interesting to see how things mix up when you have kind of 2 indices and you have other effects built in. But here in this case, the message is 50-50 brings you the highest performance, 406% plus over the period that we see here. Both extreme investments would lose money, obviously. Well, the last example that I have here, but maybe I don't want to go into this boring stuff. I was asked how to interface with high frequency real-time data. So I've prepared actually, I have to make it. I don't know if you see everything. This is kind of a little thing that I wrote up for the book. Actually, it's not like the last version, but the one that I had kind of pulled together. What I do here is I import a couple of libraries, maybe 1 or 2 too many. I don't need all of these, but this is kind of a working notebook. I interface here with a real-time Forex data API of Wanda. This is kind of the sandbox API. This is spitting out random data. Don't use it for trade. I mean, I'm querying here for the euro US dollar exchange rate, but you will see this is not kind of the current date. What I do right now is to read every single data point that I get into a data frame, and I'm updating. This looks like this. You see here the timestamp. You see this fictitious dummy data spit out here, and because I was asked for that, what I do here is kind of loop and read out every tick data, and I visualize this in real time. So I have in the background, I have a Bokeh server running. Bokeh is from Continuum, the web-based plotting engine. And when I go here, I should see right now, yeah, this is the current one. This is the European time, don't get confused. What I see here, a couple of lines of code. You have real-time web-based illustration reading out the Forex data. This could be real data, of course. And this is plotted via a server and the loop in the background. Here where you can have, this is real time. So, and a couple of lines of code. I have another example which is CSV based. This is JSON based, a little bit more easy. But you see, even such things like pulling real-time high-frequency data and visualizing this in real time, you can do interactively with Python pretty efficient. So not only that you can do like this historical analytics stuff, you could do here like derivatives analytics, trading strategies, real-time algorithmic trading. It's pretty simple to both pull and to visualize in the end. Which brings me, I'm skipping this because I've shown you this in real time, so I don't need to take my static example. This is a slide you will find everywhere. By now you should use, I should know why to use Python instead of maybe other alternatives. And it was a great pleasure to be here. Thank you for you being here, and I'm more than happy to take any questions. One question without yes.
You didn't talk about pi tables. You didn't show any applications. Could you describe where it is used in 20%?
Sorry, could it?
Pi tables.
Yeah.
You did not show any application in your presentation.
That's true. I usually, when I give kind of a general analytics talk, I have many examples showcasing pi tables. Not only how it is pretty well integrated with pandas. For example, one of the options that I recently added is kind of storing complete pandas data frames in a table format, which can be compressed. This is actually a huge gain, so you can now write your data frames in a compressed manner pretty efficiently, which can speed up I/O again, and it makes it much more, say, appropriate and efficient for like backup operations or transferring data, of course. But I don't know which point would be of particular interest for you. I mean, pi tables.
So I just want to know, when do you use pi tables instead of pandas, family, or data?
For me, it's not an either-or question. I mean, both libraries are pretty well integrated. You can like import a pi tables table directly into pandas. You can write your pandas data frame into pi tables. These are like the one thing. Usually, when I give talks, they're sometimes more in-memory heavy. Then I show more pandas. Sometimes they are more out of memory or I/O heavy. Then I use more pi tables. But in the end, you have this large intersection where both come together and where you have kind of the capabilities of both that you want to use in tandem.
What is pi tables then? Is it a database?
Pi tables is actually a Python wrapper around the HDF5 database standard file format. So which allows you, as I said before, like to to write and retrieve data in a hardware-bound fashion. So if you have a SSD drive in there like this one, you will get writing speeds and reading speeds of roughly 512 megabytes per second. This is like built in. This goes you to, or brings you to really the boundaries of the hardware. There's no software kind of thing involved. Thank you.